everyone, this is Property Mommies at PropertyMommies.com. This is Brittany Wynn with Keller Williams Partners.
And this is Gayla Bustos with Keller Williams Partners.
Today we are with the fabulous Chris Frankmount from North Point Bank. You probably recognize him. He's in a lot of our other videos. He's going to help us discuss what to ask your lender, if you're not using him, of course, when you're getting pre-qualified.
So our first question for Chris is, what are the different types of loans that you guys offer?
So we offer all the standard loans that anyone offers, FHA, VA, conventional. But in addition to those, we have a wide array of portfolio products that are specific just to our bank. There's too many to cover them all, but some of the highlights are some of my favorites. We have a lot loan to buy land that we can go as low as only 10% down on the down payment, whereas most people require 30 to 35% down. We have a doctor loan that we can go up to $650,000, fully financed, no mortgage insurance for doctors, PAs, dentists. Like I said, no mortgage insurance and fully financed. That one's pretty cool. We also have a fresh start program that we can get a loan done for a client who's only 1 year out of a bankruptcy. Nice. There needs to be some extenuating circumstances, and there's some specific guidelines to that one, but we've already done a few, so it definitely can be done.
Great. How familiar are you with all the different loan types? Because I know VA, we do a lot of VA here, but I mean there's more than just VA.
Yeah, definitely. So I'm very familiar with, the big three, VA, FHA, and conventional. I've done countless of all of them. For the more unique circumstances or special loan types, I have awesome support system. I've done some of all the portfolio products that I discussed, but the two other originators on my team, one's been in the industry for 23 years, the other for 12 years. They're awesome resources. If I ever encounter a situation I haven't seen before or something crazy that I'm not familiar with, I just pick up the phone, give them a call, and I've never been able to stump them. They always have the answers that I need.
Okay. So how do you know what is the best type of loan for a client?
Yeah, that's a great question. So oftentimes clients will qualify for more than one loan type, and in that situation I just run all the different scenarios, go through them together with my clients and put them side by side so they can see the differences and decide for themselves what's going to be best for them. One of the common examples is some clients will qualify FHA and conventional and are trying to decide the best way to go. Obviously, the minimum down payment's a little bit lower on FHA, but still sometimes conventional may be a better option. A good example of that is the mortgage insurance on FHA versus conventional. So the mortgage insurance on an FHA loan is a standard set rate. So whether you have a 620 credit score or a perfect 850, you're going to get the same mortgage insurance rate for an FHA loan. Mortgage insurance on a conventional loan varies depending on the money you're going to put down, your credit score, and several other factors. So someone with a lower credit score, like a 620, that mortgage insurance on a conventional loan is going to be really, really high, and they're better off in an FHA loan where they're using that set rate. Whereas a borrower with great credit, a 760, the mortgage insurance is going to be a whole lot cheaper for them on a conventional loan, and their payments could be a lot less on conventional than an FHA. But again, when a borrower qualifies for multiple programs, I just put them side by side. We look at them together, look at the differences, and I let them make the decision what's going to be the best situation for them and their family.
Another question that we have, and it's not really on our board that we were supposed to ask, is underwriting. What's the process of underwriting, and also how long does it take? Because this can make or break a deal.
Yeah, definitely. And that's one of the huge advantages of our bank is our underwriters are so on top of it and fast. We have a big underwriting team. We've been working on building that out over the last few months. Our standard underwriting turn time is 48 hours. That's kind of the expectation we set. I've heard of lots of banks that are 2 weeks, 3 weeks in underwriting.
Don't do it.
Yeah, thankfully for us, we're, like I said, 48 hours is our standard turn time. Right, we get an email every day with how many loans are in the queue, when they've been pulled, and what to expect for our underwriting turn times. My email this morning said every loan has been pulled. So I had a loan that was submitted at 4 in the afternoon yesterday to the underwriters, and at 10 this morning I already had my conditions list from them. So that's huge. That's how we're able to close these VA deals in 28 days or less, move up closings, while some people are taking 45 days because their underwriting takes so long. The other cool thing there is when you have a difficult file or something you're a little worried about, we're going to get an answer quick. We're going to have an answer before that loan contingency deadline, and we're going to know for sure whether or not we're good, whereas someone else, you may be risking that earnest money if you've got a long underwriting time.
Yeah, we don't want to do that for our clients.
No. So our next question is, what are the different fees that you guys charge and who pays them?
Yeah, so the fees in our industry are pretty standard. It's just a matter of whether people want to show them or not. So really the standard fees on the lending side, there's the origination fee for the loan, an underwriting fee, a credit report fee, a flood certification fee, and an appraisal fee. That appraisal fee for VA loans, it's standard, it's set by the VA, doesn't change no matter who you use. Whereas conventional and FHA loans, we set our own appraisal fees. And then in terms of the other fees for us, we show all of those fees on our loan estimates, on our closing disclosures, so our clients can see them. That's partially how we have such low rates and aggressive rates. Some lenders like to hide those fees. So the way that they'll do that is, they'll say, hey, we have no origination fee, we have no credit report fee, no fees whatsoever. But the way they do it is they just build it into their interest rate. So that's why their rate is 3/8 higher than maybe our rate is. And that's why I tell everyone, hey, if you've got a quote that sounds better than mine, please get it for me in writing. Let's look at it from A to Z, make sure we're comparing apples to apples, and make sure it's a fair comparison. Because so many people get caught up on those numbers of the closing costs or the fees, and they're not looking at the whole picture. So it's very possible that at that same rate that lender's offering, who says they have no fees, we're able to give you enough lender credit at that rate to cover all of those fees and then some. We just like to show those fees and be more transparent and give you back lender credit to pay for them when we can, instead of just hiding those fees, by not showing that lender credit.
Right, and that little bit of interest can bump you up quite a bit on your mortgage.
Yeah, definitely. And like I said, that's why I tell people, let's look at the whole picture. Let's get a quote in writing. Let's make sure we're seeing the whole picture. Not just that rate or not just those closing costs, but that we're looking at all the important factors: the rate, the bottom line, the fee estimates, and to make sure that, like I said, we're comparing apples to apples.
Right. And who pays those fees, and when do they need to be paid by?
So it depends some on the loan program. I mean, all of that's really getting paid at closing, at the closing table, when the loan closes. But for example, on VA, there's certain fees that the borrower cannot pay. So those have to get paid either by the seller or by me with lender credit. So in terms of who pays the fees, it really can change deal to deal and program to program, but they all get paid at the closing table.
Okay. Our next question is, what are the qualifying guidelines?
Well, that is a pretty tough question. FHA alone, their guidebook is 1,500 pages of their guidelines, so there's obviously a lot to it, but just talking kind of in general about guidelines. So for a conventional loan, obviously the big two are Freddie Mac and Fannie Mae. They have their guidelines. VA has their guidelines, and FHA has their guidelines. And those guidelines are really the only technical rules or what you have to abide by when you're doing a loan for those. However, many lenders do have what's called overlays or additional things that they require on a loan. So for example, VA doesn't technically have a credit score requirement in their guidelines. However, most lenders are going to require a 620 or a 600 to get a VA loan done because they know that they want to see decent credit from their borrowers. I've heard of places that'll go lower, even below a 580. I don't know about that. If it sounds too good to be true, it probably is. But in terms of overlays, a lender like us who's direct, so we're Jenny direct for our government loans, we're direct for our conventional loans, we're only subject to the actual guidelines or the rules from the loan providers themselves, not additional overlays like some lenders are. And that's what helps us get some deals done. I saved a couple deals in the last few months for people because they had overlays and that they weren't able to get around, whereas we just had to go by the guidelines themselves and we're able to get those deals done.
Our last question that we have for Chris is, what programs do you offer for down payment assistance or to help with closing costs?
Yeah, so we're licensed through all three of the major down payment assistance providers here in Colorado. So CHAFA is obviously the big one, but also CHAC and El Paso County Turnkey. Really, at the end of the day, all of those programs are very similar to one another, but it is cool that we can offer all three because sometimes one will work for a borrower that another will not. For example, the turnkey income limits are a bit higher than the CHAFA income limits. So a borrower maybe make a little too much money to use CHAFA, but not too much to use turnkey. Talking about the down payment assistance programs, there's also some different types within the providers. So CHAFA, for example, they have a 4% grant program, but also a 5% silent second program. And that silent second just came back about 6 months ago. Since it did, a lot of lenders have really been jumping on that because the rate is a little bit lower and you get 5% down payment assistance instead of just 4%. Me personally, I do not point my clients towards that program. That's because that 5% second, if you refinance the loan or sell the home in 30 years, just at all, you have to pay back that 5% second. CHFA used to be set up where it was a silent second, but it got repaid as you lived in the house. So after 1 year, it paid back 20%. After 2 years, 40%. So after 5 years, you had nothing to pay back. That's not how their second is anymore. Now, if you refinance or sell the house at all, you have to pay that back. So that's why I steer my clients towards the 4% grant program, because that does not need to be paid back. And even though we may need a little bit more seller concessions to get that done, it's still a much better program for the client and their family. You know, I never want to put anyone in a program that I wouldn't do myself, which is why I try to steer people away from that one. In terms of covering closing costs, absolutely. Again, it depends on the program. We can always build that into the rate, take a little bit higher rate to cover those closing costs. So everyone talks about, you know, paying money to buy down an interest rate, but it works in reverse as well. So you can get paid to take a higher interest rate and do that in the form of lender credit. And you can use that lender credit to pay your closing costs and your prepaid items and different things. And so that's a good option with a lot of loan programs to cover your closing costs if you don't want to bring those out of pocket and you don't want to ask for the seller to pay them because you want to have an aggressive offer.
Right. Well, thank you so much, Chris, for joining us here all the way so far away from your office.
Yeah, thanks for having me.
If you have any questions for Chris, we will definitely put his information in the comment box and you can contact him directly. Join us next week. We will be talking about the 5 myths to sell your house.
And the tip of the week this week is kind of tying into this whole video. These are not the only questions that you should be asking your lender, and these questions may have brought more questions up in your head. So we're going to post all of our lender videos below in the comments. Chris is in a majority of them. And you can watch those videos. If you have questions, contact Gayla and I, or Chris's information will be there as well. And then we will see you guys next week.
Bye.
Thank you. Bye.